we are in a banking crisis. This problem that we're having right now is very isolated, just a few banks. There aren't going to be many ramifications. It's all under control. The Fed's on it, the FDIC is on it. I think all of those variables, the credit default swaps, inverted yield curve, were pointing to two mistaken assumptions in the banking system. So I'd love to get your reaction to this.
Cathie Wood, the founder and CEO of the investment management firm ARK Invest, discusses the present banking crisis and various banks' faults that caused it. Wood analyzed how banks' pandemic assumptions affected their investments. She explained how banks put the pandemic's torrent of stimulus money in safe securities, including government-backed mortgage securities and treasuries. They were long-term and held to maturity, believing interest rates would not rise soon. Banks made two incorrect assumptions. The second mistake was not decreasing deposits, which has not happened in banking for 48 years. Yet, despite deposits are leaving and going to money market funds or being withdrawn by consumers outside the bank, Silicon Valley Bank, which struggled to get yield in a zero interest rate world, will also be discussed. Cathie Wood will discuss the bank crisis and its potential effects, emphasizing the system's inherent flaw. She also explains the banking crisis and its causes. Here's more of what she had to say.
A lot of banks that were being flooded with stimulus payments were taking that money and investing in safe securities. They're government-backed mortgage securities, treasuries, and everything. But they invested long-term, put in the held to maturity category. And in the case of Silicon Bank, they were earning really 1.6% on that book. So what was the assumption they made? They made the assumption that, gosh, we're probably going to be fighting a depression here. And surely interest rates are not going up anytime soon.
Correct.
So that was the first mistake. And then the second, and it was a pretty good assumption, because we've never had now it's a 20-fold increase in interest rates in less than a year. If you go back to Volcker, it was a 2-fold increase, 10 to 20%, that shocked the system. And what I like to say is, the system is being shocked, because more so than in the early 80s, because we had 2 weeks ago an inversion in the yield curve of more than 100 basis points. So more than 100 basis points on 4% is a lot different than more than 100 basis points on a 15% interest rate. So I've likened it to the Richter scale. So back then, if you look at 4% over 15, that's 6.5 on a Richter scale in terms of earthquake. If you look at 1% on 4%, or 100 basis points on 4%, that's a 25 on the Richter scale, which is 4 times. I'd like to get back to that in a minute, but before we get to the yield curve, I just wanted to discussion of the yield curve. The second big mistake that Silicon Valley and these other banks made is that deposits would not go down. We haven't had declining deposits in the banking system for, the latest I've heard is 48. If you look at M2, we haven't had a negative M2 on a year-over-year basis since the 1930s. So part of that, 85% of that, is deposits are leaving and going to money market funds. Or in the case of these watching Silicon Valley Bank's customers waiting outside the bank, these are high-tech investors, and they're waiting in lines to go get their money physically.
When you look at Silicon Valley Bank, let me try to describe it to you in a different way. Silicon Valley Bank had been in the zero interest rate world for a long time. They were struggling to get yield. What they did was they went out further and further on the maturity of government bonds, true, to get any yield whatsoever. So they were owning longer and longer maturity instruments there. Their liabilities were all short term. And so when the interest rates went up, as you said, If you marked the long-term bonds to market, they had huge capital losses there. They then had huge increase in expenses on their things, and what it did was it flipped them upside down. Now, the reason they went first so much is they'd had a very steep growth path before they got into this, and so other banks that had leveled would not have been nearly as predictable catalyst for the crisis as Silicon Valley. That there were other sorts of funny things in Silicon Valley Bank. The owner of the Silicon Valley Bank was on the board of the Fed, San Francisco Fed, which
Yes.
I don't think that means anything, but there was also an issue of whether the supervisory group at the San Francisco Fed did their job correctly. I am absolutely certain they did. They just went through their checklist. They knew what every asset was, and they could see how these mark-to-market. So that's what sort of triggered Silicon Valley Bank, but it's only one. Once that trigger hits Silicon Valley Bank, let me just tell you, those bonds don't disappear. The bonds don't all of a sudden get a new coupon interest rate. They're out there. And as long as interest rates stay high, the mark-to-market value of those bonds is going to be low. And that's just the nature of things. And when you look at it, if you were a depositor in Silicon Valley Bank, you too would have been running for the fire escape, and that's exactly what they were. I think it is humorous that multi-billionaire Silicon Valley executives were standing up with their hands out, help me, help me. You know, I think that's a great image. And of course, what happened then was you had the catalyst occur there, and now you see what happens with Credit Suisse and it's spreading. If you look at Republic Bank, you look at Zions Bank, you look at some of these others, it's not stopping here because the intrinsic problem is not stopped. The asset bonds are still out there. They still have the same nominal yield. The liabilities are still out there. Anyone who wants to hold a deposit in a bank is going to get paid competitive deposit rates. And so therefore the expenses are going to be higher as long as interest rates stay higher, go higher. You've got an endemic banking system problem, Cathie, which I do agree with you on. And that endemic banking crisis has to be solved with a core solution, not an overnight solution. The core solution has to be monetary policy and fiscal policy. Otherwise, it will not be solved. We do need a Paul Volcker, we do need a Ronald Reagan to give us the intrinsic solution to lowering inflation for over periods of time. But let me tell you, if I had been Janet Yellen on that Sunday night, when they made the decision on Silicon Valley Bank, I would have done exactly what she did as a short-term palliative to solve the problem. I would have guaranteed all deposits at the bank. In fact, what I would have done where I were the Fed and the Treasury in line with their drawing facilities, I would have guaranteed all deposit at all banks in the U.S. at that time, irrespective of size. You do not want depositors as a bank to be the most expert analysts as to the solvency of the bank. And the last thing you want to have happen is you don't want a liquidity crisis to morph into a solvency crisis. This is when I saw you referenced it on TV the other day, and thank you for giving me credit for it, but it's the old adage of the banking system in the 19th century, in times of crisis, discount freely. And that is exactly what the Fed is supposed to do in times of crisis. But what we need to have, Cathie, and what you've been the shining light of doing, is we need to have a stable valued numeraire. And that's what we need to have, is a stable valued numeraire, not a stable quantity numeraire, but a stable. We want the government to set the value of a unit, of a numeraire, and then let the banking system and the other financial markets develop around that stable value. The reason you need a stable value is because commodity sellers and buyers need to know what the price level is going to be a year from now. We need bond people need to know what the value of it is when the maturity of the asset comes due. We need to know what that is. And slight missteps in the balance between values can cause enormous damage to credit markets, to investment markets, to the monetary system. The reason I think of as that is there's a flight to quality. That people are worried about banks. They're worried about really having their deposits guaranteed by the Fed. And so as they fly to things, they go out and buy the bonds themselves rather than holding a bank's assets, which then in turn buys the bonds. And so they feel much more secure in the value of their assets. And so that increased purchases has dominated the supply effect of the Fed trying to run off the balance sheet, lower their balance sheet, which is still very, 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 very large.